The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A downside surprise on U.S. eco data and upside surprise on Chinese eco stimulus. Live from Studio 2 here at Bloomberg headquarters in New York. TGIF, I'm Romaine Bostick.
TGIF, and I'm Alex Steele. Also a little bit of de-risking as we head into the weekend. Don't want to take on too much of those positions. Here's what we check here at 3 o'clock in the afternoon. You got the S&P pretty much flat on the day. It's tech that's getting hit the hardest, down over 1%. There's now a report that Bloomberg had that potentially China is going to limit the chips that it can buy from NVIDIA, and that weighing on that stock, that weighing on the indices. And I mentioned kind of taking risk off the table, putting money into the bond market with yields lower by about 6 basis points remain.
Yeah, kind of interesting to make something out of the price action today, but when you take a look at it holistically here, that downside surprise in the latest data on personal income, spending, and inflation, that actually did appear to validate the Fed's jumbo rate cut last week. But it's also appearing to really befuddle bond investors out there who continue to seesaw between buying and selling. Think about this. The net result of it all, you have a 2-year yield that has swung about 13 to 14 basis points this week from peak to trough, but it's going to end today, right now, less than 1 basis point away from where it was the previous Friday. So basically nothing. Now, the bid into equities worldwide, that has been much more definitive, at least on a weekly basis. China's daily stimulus right now priming the pump for more liquidity to enter markets. And this at a time when global financial conditions are already a touch loose. The Shanghai Shenzhen 300 rallying 16% over 5 days for its best week since 2008. And that's underpinning the best week for emerging market stocks since 2020. It's also putting bids under mining, casino, and luxury apparel stocks, each of which are highly dependent on Chinese demand. LVMH having its best week going back to 2001. Macau casino operator Melco up 30% over that same stretch. Estee Lauder gaining 19, Canada Goose adding 18, even mid-tier luxury brand Tapestry on a 5-day run, matching its second longest daily win streak of the year.
A lot of what we're seeing in China is market supportive, but not necessarily economically supportive. We've had head fakes before. It takes the real economy in China getting firm footing to really justify the kind of rally that we've been seeing.
And Alex, it'll be interesting to see how this, I guess, stimulus, if you will, starts to work its way through the system. We talk about financial conditions. I mean, I thought they were already kind of loose. And
there could be getting looser and looser and looser. This is a conversation that was heard over the last 24 hours, right? Do you wind up seeing more liquidity come in from China? A lot of investors and funds getting caught way offside with that money coming in, having now to right size positions. On a fundamental basis, though, that global easing cycle, that's what's taking dominance. Now, you're taking a look at this blue line here. It's the U.S. Financial Conditions Index from Bloomberg. The higher it goes, the looser conditions are. And this white line is the S&P. And I just draw your attention here to the loosening of financial conditions as well as the rally within the S&P. Now, if there is some kind of catch-up trade or rejiggering when it comes to that China liquidity, does that even increase stimulus here in the U.S.? Does it increase financial conditions? And then do you have like a FOMO melt-up in the equity market, Romaine?
Yeah, absolutely here. And of course, this gets to the real reading of the tea leaves that I think investors have been trying to do, not only of financial conditions, but economic conditions as well. As we kick you off to the close here on this Friday afternoon, let's bring in Sonia Meskin. She's senior economist for UBS Investment Bank, joining us here in Studio 2 on a day where we got a little bit of economic data, at least here in the U.S., the personal income and spending and PCE data, as well as UMich consumer confidence numbers. I want to start with PCE first, because we did see a little bit of moderation in incomes, a little bit of moderation in spending, but we also saw a little bit of moderation in inflation. So I don't know whether that's good or bad.
Well, it's consistent with the outlook of softening growth, softening demand, and softening inflation, but nothing falling off the cliff. So it is consistent with the Fed story, and it's also consistent with our outlook.
When you look at the economic data itself, the hard data, and you try to pair that up with some of the sentiment surveys, the idea that how the economy might be doing is not necessarily how consumers are actually perceiving it, kind of reconcile that for us, particularly in light of the University of Michigan data?
That's a very interesting point, because it used to be that actually consumers would not necessarily be very optimistic precisely because they were bothered by higher inflation. And now that inflation is coming down, we've seen this divergence in some of the surveys. The Conference Board survey, for example, earlier this week was more pessimistic than the UMich survey final numbers today. And part of it has to do, we think, with the fact that the numbers for the Conference Board were released before before the Fed lowered rates, whereas the UMich survey was done after the Fed had lowered rates. But of course, there are other differences in the surveys as well. And the Conference Board survey is more focused on the labor market. The UMich, we saw inflation expectations longer term actually kind of stick up.
So if we take a look at the soft landing scenario then, right, and sort of how all the data we're getting seem to support something relatively along those lines, right? Is there a risk, though, that growth actually reaccelerates here as financial conditions do get looser, as more money comes into the economy in China?
Well, we also think that fiscal stimulus here, the effect has been actually waning and will continue to wane into next year. So for the U.S. at least, we do expect continued deceleration in growth, nothing falling off the cliff once again.
So in theory, there's nothing to shake the Fed off its course of its easing cycle 25 or 50, right? Is that what basically you're saying?
We would say unlikely, yes. The debate is more around the pace and the final destination.
So let's talk about the destination, because I do want to know where we're going. And I know that's always the question every economist gets asked here. But there's this idea that we sort of escaped the worst. Last year, everyone was pricing in a recession. We didn't get it. Now the narrative is about a soft landing. If this is still the same economic cycle, it's got to be towards the end of it, doesn't it?
Well, we had a very long previous cycle that was only really interrupted by an unexpected exogenous event. So there's nothing really to say that a soft landing is, very unlikely, even though historically they have not been very likely. But the Fed's reaction function has also changed relative to history.
There has been some concern, though, that we are leaving ourselves vulnerable to another exogenous shock. Obviously, you have a major election year in the U.S., a lot of unresolved military and geopolitical conflicts, and a few other things also on the economic front. And I'm just curious, and as an economist, how do you try to map that out? Because I know these are all still hypotheticals to a certain extent in terms of how they affect. But the fact they seem to be lingering for so long, I know investors have gotten worried.
Yeah, for sure. And we think the fiscal trajectory is something that is not only going to be top of mind in this particular election, but also longer term, since obviously they could push up the term premium quite a bit in the coming years.
Okay, so that's the medium term, right? Let's get to the next 8 days. Jobs Day next Friday. What are you expecting? What's the reaction function of the market?
Well, the really interesting thing I think about the upcoming job report is the potential revisions to August, in fact, right? Because the response rate in August tends to be very low. So the BEA typically miraculously finds about 100,000 more people on a non-seasonally adjusted basis with the revisions to the August numbers.
So if it's too hot, what happens? Like if the number's too hot, does that change how the market views what the Fed's going to do?
It could potentially change, the expectations for the pace, right? But it will be very important for the Fed to actually, in the coming days and weeks, to telegraph their reaction function to the data, which they've done individually, but they haven't really coalesced quite yet around a singular reaction function.
Before we let you go, I do have to ask you about China and this basket of stimulus. I don't know what we want to call it, and obviously it hasn't really taken hold yet. This is the world's second largest economy. We know the potential contribution that it can have on global growth, or for that matter, global malaise here. What we know publicly, do you think that is going to have a material effect on the global economy?
Yes, you're right that China does have a material effect on the global economy, just like the U.S. does. And I think in the PPP terms, China is quite a bit bigger than in nominal terms already. It's unclear how much the recent stimulus is going to make a big change to the Chinese economy itself. And I think that would be the first point to start.
All right, Sonia, great to always have you here on the big program. Sonia Meskin there, senior economist for UBS Investment Bank, kicking us off to the close here on this Friday afternoon. When we come back, we're going to continue to monitor the devastation and the loss in the wake of Tropical Storm Helene. We're also looking at the financial impact that could actually fall on the world's biggest commercial insurers.
All right, plus we're tracking the latest updates from America's national rail operator, how Amtrak is fending off competition from the private sector to keep its business models on the rails.
And from trains to boats and, ports, we're eyeing the potential dock workers strike that could start as soon as Monday night. That is along the East Coast, but it could have massive reverberations on the West Coast and the Gulf Coast as well. A breakdown here of what to expect a little bit later, right here on The Close on Bloomberg.
Tropical storm Helene is making its way up the East Coast, bringing heavy rain, severe flooding, and winds of 70 miles per hour along its path. Helene made landfall on the western coast of Florida late last night, knocking out power for millions of customers across the state, now many of which don't have insurance to cover hurricanes and inclement weather. Romaine and I caught up with Lloyd's of London CEO Neal to talk about how natural disasters are impacting both customers and insurers.
It was supposed to be the worst North Atlantic hurricane season on record, and it's been relatively quiet. And so here we are in Climate Week in New York, and a hurricane runs into Florida and up into Georgia. So I think comfortably manageable. I know that's a terrible thing to say against the context where there is damage and there is some loss of life, but you know, it's interesting trying to predict these hurricanes. It's a tropical storm as it's running through the Atlantic. It's Category 4 by the time it hits Florida. It's Category 2 as it moves into Georgia, and now a tropical storm. So well within the sort of range of expectations we'd expect for a hurricane. So yes, exposure, but nothing that would cause us financial concern.
But what we do see, though, is a lot of insurers dropping coverage for homeowners, for example, say in places like Florida or even by the Jersey Shore, because the risks are just so great. Are you doing that right now? And if so, in the U.S., where?
Not particularly. I mean, I think the oddity is that it's often not the big events that are causing the problem. So if you remember Hurricane Beryl coming through much earlier on in the year going into Texas, what everyone forgets was it was followed by 102 tornadoes. So it's often the complicated, frequency of tornadoes or convective storms that are causing the issue. And you've got that complication with insurers turning around saying, well, we're going to have to reprice the cost of homeowners. We might have to reprice auto for different reasons associated with litigation. And then they're in a debate with the regulator. Can I change my price? Can I not change my price? And then you get this standoff, which is what's happening a little bit. Good news in somewhere like Florida was you'd got some sensible tort reform. Litigation being an extensive problem in Florida. In California, they're going to have to work through, I think, the framework of what is the right price for some of these covers. So I don't think it's a lack of availability of capital or capacity. It is what is the price for the risk.
But a lot of that risk now is being dispersed. And you mentioned the regulators here. I mean, certain states now, at least when it comes to flood and some of the things like you're talking about, the add-on effects coming out of these storms like tornadoes, a lot of that burden right now is on some of those local governments and to a certain extent the federal government.
It is. I think we're at an interesting tipping point, which I think is good news, where I think a number of the actors need to sit in the same room to sort these problems out. So the banks own most of the assets. They own the assets. So they need to be in the room and understand the responsibility they're creating. The insurers have to sit there. So do the regulators to understand what the implications of change look like, and government as well. But government then need to understand the responsibility that's being put at the front end so we can clearly push them to the back end. We can't live in a society where we pull the government to the front for all these conversations.
But this is largely a global phenomenon when we talk about the climate risk. As far as being able to shoulder that burden or sharing that burden, meaning the federal government or the local governments, that's still, at least right now, largely a U.S. phenomenon. You're dealing with issues in Europe as well, but you don't necessarily have that same sort of government involvement in taking on some of that risk?
No, not at the moment. I mean, I lived in Australia for 7 years, and if you live in Australia, the weather events are biblical. If you looked at flooding in Queensland, a landmass the size of Germany would flood. I mean, they call them bushfires, not wildfires. You'd have 2 million hectares on fire. But you hadn't simply got the population complications you have in the US. But I think the same rules apply, where I think there is an understanding now that more than one constituent needs to be sat in the room: banks, insurers, regulators, government. Because it's not a lack of capital. It's not a lack of capacity. I mean, we've got to have the right conversation around price, but it needs more than one party just to be in the conversation.
So you might still then be in the room for everything, but are you noticing other companies pulling back and you're picking up the slack, ensuring some areas that other ones won't touch now?
I think what's happening, so where the US is different is it has two different types of market. It has the market that as a rule deals with the traditional retail insurances, the home and auto, and then when it gets complicated, cyber and other related insurances, you have this more mass market capability, which includes international interest. So much more of it is going into the latter because of the difficulties in setting the frameworks for the basics of dealing with admitted insurers. I think it genuinely needs some thinking around how we're going to make this work. At the one end, you've also got complicated litigation-related issues which are adding to the cost of claims. I think that needs to be addressed. We do need another spate of some tort reform to think smartly around what that needs to look like.
It seems like a lot of big asks that you have to sort of like go through. And then we haven't even touched the reinsurer part, right? Because if reinsurers want to hedge their risk, then your prices go up and then that trickles down.
So I think what's happened, and it's happened over a 3-4 year period where prices changed quite dramatically. I think there's some stability now, honestly. I think the insurers and reinsurers are in a position of price stability. I don't think that means prices going down, but it means price stability. But I think we've got to do a better job at our end of explaining risk, because you still have a lot of underinsurance. You're asking me the question about Europe. Half the level of cover is bought in Europe that is bought here in the States. So when you look at the flood issues that I think you're hinting about, there's a lot less cover. And I think there is a responsibility on us to say, hey, we do understand the exposures are here. We do have the capacity and the interest to provide insurance. There is a risk. It is worth buying insurance. It is worth taking it off your personal balance sheet or your business balance sheet and putting it with the insurer.
And a great conversation we had earlier today with the CEO of Lloyd's of London, John Neal, who, of course, was in town for UN Week. And, of course, he is here in the U.S. just as Tropical Storm Helene made landfall down in Florida. And you can track the path of that storm by typing in Maps Go on your Bloomberg terminal and clicking the cyclones function there. And, of course, we will continue to monitor any sort of loss that comes from that, and as well as any sort of financial fallout. All right, coming up here on the program, we're going to take a closer look at the hardware company HP Inc. Computers and printer, and well, there might be a problem with some of those printers. That's according to an analyst over at Bank of America. We're going to discuss that in our top calls. That's coming up next. This is The Close on Bloomberg. All right, let's get a view from the sell side with our top calls. Big movers on the back of analyst recommendations. And we start off today with Dollar General getting its first sell rating in more than a year. A downgrade today from Citi analyst Paul Lejuez, who says Dollar General will continue to suffer from Walmart's market share gains. He says while Dollar General is known for value, industry dynamics have changed, and Walmart is going to be too tough to beat on price. The share is nevertheless getting the bid on the day. Next in line, let's take a look at Wynn Resorts. The casino operator raised to overweight from equal weight at Morgan Stanley. The analyst saying despite the China stimulus-induced rally, Wynn's valuation is still discounted. It's got some room to grow, creating an asymmetric risk-reward profile. He also cites a project the company is working on in the UAE that could be additive to the bottom line. The share is getting a nice boost on the day, up about 7%. And finally, let's take a look at HP Inc. Shares lower today after Bank of America downgraded the stock to neutral from buy. The analyst over there, Wamsi Mohan, says the computer hardware company has been, quote, over-earning in print. And margin erosion in that unit will offset upside from the personal computer business. He's still holding a $37 price target on the stock, though investors bidding it down today by about 3.5%. Those are some of our top calls, and we do want to stick with that last one. And pleased to say that Wamsi Mohan is joining us right now, senior IT hardware analyst over at Bank of America. So let's just start off right now with what's actually ailing that print side of the business, Wamsi.
Yeah, thanks for having me on, Romain. Look, I think that the print side of the business has been challenged now for multiple years. What you had during COVID was this distortion where you remember everyone was working from home and you needed to buy printers. And so both the pricing as well of the hardware, which is unusual to see pricing of hardware go up, but pricing of hardware did go up for a couple of years. And that allowed for better margins than normal. Then you had a lot of cost takeout, which was driven by prior CFO Marie Myers. And that also has helped keep these margins relatively high. Now, that said, what's happened to the yen in the meantime is that, and remember, a lot of these printer competitors are global international ones. Yen's gone from 110, 100 to 160 and back to 140 now. And that just creates a much more difficult environment to compete in. Plus, HP shares some of its profit pool with Canon on the laser side. In the meantime, you also had shrinkage of the install base of inkjet printers because the last year, printer units were declining at least 20% year on year. So we're entering a phase now where it's going to be more challenging to monetize that install base of printers, which has shrunk. At the same time, competition is intensifying, and the benefit of those cost takeouts is kind of already reflected in the P&L.
Wamsi, what about the AI component to all of this? Like, clearly that's not a shoo-in for HPQ. So, like, how can they benefit or participate in any kind of refresh cycle when it comes to AI?
Yeah, thanks, Alex. Good question. Look, so AI PCs, I think the jury is still a little bit out, right? Like AI. So one thing is you can sell AI-enabled PCs or capable PCs. The second is how soon will that refresh happen? As we're seeing that AI adoption in the enterprise has been kind of slow, even on the server side, we think PCs will just be a lower priority relative to the rest of the IT infrastructure that has kind of been starved a little bit at the expense of servers. And so we actually expect servers to benefit first. We expect storage to benefit next, and networking, and then far down below would be PCs. There is a PC refresh cycle because of the echo of the COVID boom, which has partly happened. Some of it is consumer, which will get pushed out. Chromebook, we don't think will be a big driver. And so it just leaves a little bit of enterprise, PCs that could see some refresh. You've also got Win 10 expiry, the end of life support, which we think will create, again, a little bit of upside. Now, both those put together, we're still seeing that 2024 got derated from a mid-single digit to low single digit growth now. Yeah. And we think that the same could happen even in 2025, where the growth expectations are much higher today, but get derated over time.
What is the long-term growth story for this company? Because there's been a lot of talk, particularly once they had that big separation a few years back from HPE, and this idea that they were basically jettisoning off a legacy business. But have you seen the CEO articulate a longer-term growth strategy? What makes this company something bigger than what it is?
Yeah, it's a good question, and I think part of the portfolio, especially on print, is relatively challenged from a growth perspective, and that's just the reality of where we are with the print business. It's change of habits. It's people print less. There's more stuff done electronically than using paper. And there are areas of growth within print, right? Like subscription ink, for instance, is growing, and they're trying to bundle that with subscription paper as well, or all in one bundle. So yes, there are certain areas, but the overwhelming majority of that revenue stream is still shrinking. PCs are more cyclical. You can see some growth at some times, not some growth at other times. There are other areas of growth that the company is exploring, and that is growing to be an increasingly larger piece of the business, but the materiality of that in terms of adding to growth is not yet at the level where some of these cyclical elements in PC or secular declining in print.
Wamsi, we gotta leave it there. Thanks a lot. We really appreciate it. Wamsi Mohan over at Bank of America. That stock, though, for the year, still up 17%. All right, coming up, a check on with the U.S. computer with Roger Harris, president of Amtrak. This is The Close on Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to The Close. I'm Romaine Bostick.
And I'm Alex Steele. Guess what's outperforming today?
What's that?
Dow Transportation Index. And I wonder if that's a China effect or if it's growth here in the U.S. effect, but it is outperforming.
Yeah, it was kind of interesting. I saw earlier this week, you saw airlines rallying, a lot of transportation stocks rallying as well here. And of course, I think a lot of us, at least certainly here in the U.S., obsess over some of these transportation stocks. Yeah, that's right, because we try to get from point A to point B, and if you're in New York, that's impossible, even when it's not UN week here. And of course, it raises a lot of questions here about the infrastructure that we have to move people around. So whether it is by land, air, or sea, you have a huge amount of passengers utilizing U.S. transportation systems every year, more than 300 million. And just last year, 28 million of those passengers chose, well, what you're looking at there, Amtrak, formerly known as the National Railroad Passenger Corporation. Amtrak has remained one of the go-to services for intercity rail travel, particularly here in the Northeast. But it also has challenges, be it outdated infrastructure causing delays or increased competition from other private rail companies. Here to talk about all that is, well, the president of Amtrak, Roger Harris, joining us right now from Union Station down in Washington, D.C. And Roger, great to have you back here on the program. I do want to start off. You guys have been spending a lot of money. Last time I checked, at least in the fiscal year last year, 2023, you had one of your biggest capital investments. The Biden administration gave you a big shot in the arm about a year ago, funneling several $1 billion to railroads here. How exactly is that money being spent?
Hi, Romaine. Thanks for having me back. It's good to be here. Well, it's going on a lot of different things. It's partly going on new fleets. So we have new trains coming. This winter, we're going to be hopefully putting into service our new Acela trains. Coming after that, in 2027, we will be launching our new Aero train sets on the Northeast Regional Service in the Northeast. So really a complete makeover of the trains that we have in the Northeast of the U.S. We're also spending a lot of money on new infrastructure, not only in things like tracks, signaling, and electrical infrastructure that really makes the railroad run every day, but also those really big 100-year investments in things like major bridges and tunnels. And that's really a lot of the work that we're going to have getting underway in earnest in 2025. So you mentioned that we had a lot of growth in our capital spending in 2023. Well, right. This year, 2024, we grew 50% from 2023.
And is that going to continue into 2025 and beyond? And if so, Roger, are some of those costs, are they going to be passed on to the commuter? Are they going to pay more in ticket prices?
So the large infrastructure items that we're talking about are primarily funded through the IIJA at this point. They won't inherently be passed on to the commuter in that form. We have a lot of other costs that are going up, though, at the same time. So there are price increases probably underway, but it's for all kinds of other inputs.
Roger, it's Alex. What's the biggest hurdle to you building these projects on time and on budget? Like, what's the risk that you take on in the medium term?
Alex, great question. One of the things we've done since the money was awarded is we have built up an incredible infrastructure of project management, project controls, things to make sure that we get the projects done right and that we don't have a lot of unpleasant surprises later on. There are a lot of steps that we have to go through, including environmental clearances, historical clearances. We work with our partners who are part investors in these projects, and those steps typically take a number of years. And that's why you don't see these projects delivering benefits yet, because the setup of the projects really takes a long time, but it's a necessary part of making sure that they're successful in the long run.
So then how do you compete, back to Romaine's original question, how do you compete then with more of the private players who can get in there in a different way and move money faster and build projects faster?
Very good question. We have a lot of efforts underway to be more efficient. So when you look at, for instance, our new Acellas that, as I said, we hope to launch this winter, they carry about 25% more customers than the previous Acellas, and they're about 25% lighter. So they're actually going to be 20% more energy efficient, and that translates directly into lower operating costs, especially on a per passenger basis.
You know, Roger, I am curious, when we talk long term about the future and the health of Amtrak, when we talk about the number of miles of tracks you have, the number of passengers you have, a lot of that is still, and correct me if I'm wrong, still weighted towards the Northeast corridor. And I am curious as to whether there are ambitions to do more outside of the Northeast, whether there is profitability to be had outside of the Northeast. Is there?
I think so. I mean, there's some very unique features of the Northeast corridor that do help to make it profitable, including density, congestion, et cetera. But those things are happening all over the country as the country grows. We've been investigating the Texas High-Speed Rail project to see what we can do there to assist in the development of that project, because we think that's very promising. It's between Dallas and Houston, it's a metro market of 15 million people. And perfectly situated for high-speed rail. We also have really exciting developments in North Carolina with the S-Line project, which also got some funding in the last round of grants from the FRA. And we continue to work with our partners in the Commonwealth of Virginia on extending and expanding rails between Washington, D.C. and Richmond, Virginia, which will eventually connect to the S-Line projects.
In addition to those issues, there's also the issue of delays and other things. Some of that has to do with of course, the tracks that you control or rather that you don't control. I know you guys have made some deals recently that gives you more control of tracks. Even in Union Station, where you're at right now, you've gained a greater degree of control of what comes in and out of there. Do you have more leverage to do that in other cities and other regions as well?
Well, I think we do. One of the things that we're really focused on is working with our partners to have the kind of relationships that really enable those improvements that you're talking about, whether it be our host railroads, the freight railroads that we run on. We're really trying to work hard to make sure that we understand their concerns. And also, all over the country, we work with commuter agencies who are also an important part of the rail environment. And they're necessary parts of the environment in terms of the investments that need to be made.
Yeah. One just final quick question here. And you mentioned the host tracks that you're on. Obviously, a lot of those either owned or operated by the freight companies. There's a big potential strike in East Coast ports. It could have reverberations on rail lines. Is that going to affect Amtrak at all?
We don't expect it to. I mean, there may, in isolated situations, create congestion on the freight lines. But we don't expect it to impact our operations.
All right, Roger, we'll let you get back to work. Appreciate you taking time to be with us today. Roger Harris, he's the president of Amtrak down there in Union Station in Washington, D.C. How are you getting home tonight, Alex?
Train, F train.
F train.
Woohoo, which has been delayed like crazy this whole week. What about you? You're walking, right?
They have the little Bloomberg Maybach waiting for me outside,
of
so
course.
I take that. But they make me ride in the front seat though. All right, coming up. Yeah, I know it's tough. Coming up, we're going to take a look at shares of Nvidia near the lows of the session. This as China is actually stepping up pressure on its own companies to not use the American company's chips. We're going to talk about that next in our Stock of the Hour. This is The Close on Bloomberg.
We're tracking shares of Nvidia here. That stock down over 2%. Tech is the worst performing sector within the S&P. Here's the why. Beijing is stepping up pressure on Chinese companies to buy locally produced AI chips instead of the global chip makers' product. Bloomberg's Abigail Doolittle joins us. Now, just how much money do we know does Nvidia get from China?
Well, they receive about 20% of their revenue, their 2024 revenue for all of their chips. And I actually did not put that into dollars, so I'm going to do that right now by using the Bloomberg terminal and typing in the FA function. I'm just giving a little tutorial.
I love this. Real-time tutorials right here on the program. Yeah.
And so you go to the FA, which is all of the financials. You go to segments, and then you go by geography. And so then on this, revenue foreign. So below foreign, there's China. It's about 17% or 22%. No, it's 17%. So it's actually even less than what I said, which is about $10.3 billion.
But that's still a lot of money, right?
That's still a lot of money. Yeah. And so we don't know how much of that, but any piece of it is a lot of money. But I think it's also a matter of the sentiment here. It's just not a great headline to hear. And I should mention, it is, of course, a Bloomberg exclusive, that they are being encouraged. This is the interesting thing. It is a window guidance rather than an outright ban. So it will not be enforced by law, but the Chinese government basically...
Yeah, but this gets back to that tit for tat. I mean, we kind of go back.
Yes.
I mean, remember during the Trump administration, we would put tariffs on something, and they would just create some random tariffs for us. And now we wonder, are we going to be back in this tit for tat when it comes to AI and chips and everything else, no matter who the president is?
Well, that's a great point. And this is a tit for tat because this is China firing back at U.S. curbs, specifically around NVIDIA from 2022, because NVIDIA did not want to share their AI chips, but what they did is they sort of dumbed down one of the chips. It's called the H2O chip. So they're okay selling that, but China is saying that's too fast and that Chinese companies need to buy or should buy from China chip companies such as Huawei and Cambricon. So, I think you're right. I think that this could be a back and forth.
But I just wonder, does this have any real material impact on NVIDIA? Because if they weren't allowed to sell these higher end chips anyway by the U.S., and then I guess whatever China does in retaliation, I guess it hurts them to a certain extent, but there's still a lot of demand out there. I mean, they've got a backlog last time I checked. So I'm sure if one customer says, I'm not buying any, there's going to be another customer waiting right there by the door to snatch that up.
Yes. Well, in terms of the H2O chips, we'll have to do a little bit more research on whether that's the case. It seems as though it could be material to number.
H2O, that's like water.
It flows like water.
Okay, yeah.
Separately, we were able to doorstep the CEO, Jensen Huang, of NVIDIA, and he said they try to comply with whatever policies and regulations are being imposed. They do the best they can to compete in the markets that they serve. They got a lot of customers. We're going to try and support them, so kind of continue to toe the line on what to expect from NVIDIA.
Yes, and that was before this exclusive, I'm guessing, and maybe, well, I won't guess. That was before our exclusive, and then we reached back out on guidance, and they did not say anything else, nor did the Chinese government, which we faxed apparently for comment. But yes,
which we faxed?
Yes, I found that to be a very interesting part of this story that we faxed.
So I've learned two things. First of all, you taught me a great function on the system here, and now apparently we're still using faxes.
Fax.
What's a fax again?
I don't know. I don't know when you'll ask HP Inc.
Yeah, that's right.
They still
they would love me to know that. All right, Abigail, thanks very much. Bloomberg's Abigail Doolittle joining us there. What I do think is interesting, though, is that if you have to ramp up the risk in certain tech names, which then weighs on overall tech, what do you do if tech doesn't lead?
Yeah, and look, I mean, we joke about this, but this could have some real ramifications for the market over time as it sort of, I guess, it works itself out. I don't know.
Right, or just gets worse at the end of the day. But what happens if tech is not the leader? Right, I am that person. It's because I'm a little Irish. All right, we're going to count you down to the closing bells here. 15 minutes to go. Ellen Hazen, Chief Market Strategist and Portfolio Manager at FL Putnam, will be joining us. What do you do if tech doesn't lead? This is Bloomberg.
The really interesting thing I think about the upcoming job report is the potential revisions to August, in fact, right? Because the response rate in August tends to be very low. So the BEA typically miraculously finds about 100,000 more people on a non-seasonally adjusted basis with the revisions to the August numbers.
All right, Sonia Meskin there over at UBS Investment Bank helping us kick us off to the close just about 50 minutes ago. Of course, she's pushing ahead, looking ahead to that big jobs report that's going to come a week from today. We've had a lot of economic data this week that I think gave some clarity, or did it?
I don't know. Or is the story really just about China and the ramped up liquidity there and what that means for the global markets, right? You got the S&P down 0.1%, not that exciting, but that Golden Dragon China index, that is up for 3 weeks in a row, the highest level so far this year. The materials sector, aside from today, had a record rally this week.
Yeah, and in fact, I mean, when you look at, we're going to get to the superlatives in about 10 minutes here, but there's superlatives across the board, not just for equities, but also in the commodity space, as you just talked about, a lot of individual names. And then kind of interesting moves in the treasury space, too. Not quite what you would have expected coming off a big 50 basis point cut just a week and a half ago. And then, of course, some of the other monetary policy commentary that we've gotten.
Yeah, a lot of churn there for the front end.
Absolutely. Let's keep things moving here with Ellen Hazen. She's the Chief Market Strategist and Portfolio Manager over at FL Putnam. She joins us here in Studio 2. Counting down to these closing bells and what has been a pretty phenomenal week, globally speaking here. And I do wonder what investors are looking at. We talk about economic conditions here in the U.S. and maybe improving economic conditions in China, if you will. Is that going to be the next big catalyst for this market?
Absolutely. That's the right question to be asking, Romaine. At the end of the day, stock markets follow earnings. And what we've seen in the U.S. is earnings estimates going up, not only for tech, but it's broadening out to industrials, to materials, to healthcare. And so that's positive for the market. Similarly, in China, we've seen that enormous monetary stimulus and then more recently the fiscal stimulus. Is that going to be big enough? I don't think so yet. But clearly, the president is very focused on that. And so he's going to take more steps until he can get the economy going. And again, you'll see it in the Chinese earnings. And when you begin to see those inflect positively, that's when you can see a bigger leg up in China.
I am curious as to what you and your team over at FL Putnam are buying and whether that's changed materially, say, versus what you were maybe doing at the beginning of the year.
Absolutely. So again, we look at corporate earnings. If you look at what's happened this year, we've seen inflation come down. We've seen GDP be stronger than expected. We've seen jobs be stronger than expected, even though jobs have weakened a little bit recently. And so it does look like the Fed is doing the soft landing. What that means is that a lot more sectors of the economy can do better than we thought, say, 12 months ago, or even 6 or 9 months ago. It was just tech, tech, tech all the time. In January and so forth, you saw the Magnificent Seven. But now, again, if you go back to the earnings, you look by sectors, you see a broadening out. And so we're buying industrials, we're buying healthcare names, we're buying areas beyond just the big tech stocks.
Does that mean that on an index level, though, without tech, is the index level going to have a struggle to make new highs after new highs because it's going to be the sector turn?
I do think that there's likely to be volatility as we go forward, not only because of the starting valuations where we are now, but also because you're right, under the surface, it's like the duck furiously paddling, right? You get rotation among the different sectors, and the tech, it will probably pull back or at least tread water for a while. And so you do get some under the surface, but because tech is such a big weight in the index, it will have a negative impact.
That's how I feel every single day, a duck under the water. If you're looking for cyclicals, though, and undervalued names, and China is pumping money into the system, is that like a green light, though, for things like Europe or, say, luxury stocks or luxury car stocks, like the DAX? Like, do we need to be thinking globally from that sense?
I think it can be, but I want to wait until I see the whites of their eyes for something like that. If you look at the luxury market, for example, particularly the European luxury market, but also the U.S. luxury market, it's just been one faceplant after another. It's been very, very difficult because of China. So it may be that the Chinese consumer, which is what you need for luxury goods, can improve. But if you look at the Chinese consumer sentiment, doesn't look that great. So we see these announcements of stimulus. A lot of it's going to be infrastructure spend and things that I think will benefit the industrials more. So I would focus more on industrials before I would focus on companies that are likely to benefit from Chinese consumer strengthening.
I saw one of the stocks that you guys have embraced was Eaton. Talk to us a little bit about that.
Yeah, so that's a company that was completely out of control with the AI trade and with China. And it was a ridiculously high multiple, but that's really pulled back since then. And it's still fairly high, but it's growing earnings double digits, and they benefit from electrification. And that is happening not only in China, but also here, and that is just accelerating as we go forward.
When I hear electrification, though, that this gets us back to infrastructure. And whenever we talk about infrastructure, I know there is a growth story there, but there also seems to be like a tinge of defensiveness to the embrace that we've seen some investors doing in that space. Is this about the long-term growth, or is this about, I guess, being defensive and protecting yourself in an uncertain time?
It's a little bit of both. I do think that the growth is going to be higher going forward for Eaton, as well as Emerson and other industrial that we like, where the growth is accelerating, not only top line, but also margins because of portfolio restructuring. So I think it's both. I think you get infrastructure spend here and globally, and you do get a little bit of defensiveness relative to some other areas of the market. But Emerson, for example, usually trades at parity with the rest of the sector, and it's at a 20% discount because of the fears about China. And it looks like those are going to be addressed, at least partially.
Does that expose you, though, to political risk in case things change, a la the IRA, if we get a change in administration?
Yes, it does. So, of course, not everything in the IRA can be undone all that easily. And as we have discussed many times, a lot of the jobs that were created from the IRA are in so-called red states, and that may cause any rollback efforts to be modified or constrained a little bit. So, but it is always a little bit of a political risk to do that. But having said that, eventually that is likely to happen, whether or not it's this administration or later on.
Before I let you go, you mentioned healthcare. Where in healthcare do you like?
We're looking at some biotech companies, particularly a name like Vertex. Cystic fibrosis, they have a great drug coming out over the next couple of years that is really set to improve margins and growth rate.
All right, Ellen, always a great conversation. Great to see you in person. Ellen Hazen, she's the Chief Market Strategist and Portfolio Manager over at FL Putnam, helping us count you down to the closing bells here on this Friday afternoon. A Friday afternoon, Alex, well, on a daily basis, we're seeing stocks a bit on the back foot, but of course, on a weekly basis here, gains across the board.
Yeah, particularly when it comes to any stock related to China. Like S&P Materials, you had a record rally this week. It's been a very big day. You look at the Golden Dragon Index as well. Also a tremendous week for those for that index.
But then interesting to see a two-year yield right around 3.56, which isn't far from where it was a week ago, despite all the sort of volatility in between. And the VIX elevated today, but still below 17.
So my question, though, still remains, what happens to funds that were caught offside by China? Do they have to reallocate quickly? And then does that sort of create much more churn within the market? And how long does it take for that to settle out?
Yeah, what was the great story in the Bloomberg with the interview with David Tepper? David Tepper basically buying everything he could out of China right now. So obviously a bit of an outlier, at least for him. But a full breakdown of all your market coverage that's coming up right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here, alongside Alex Steele, taking you through the closing bell, a global simulcast. It starts now with Scarlet Fu joining us in the TV studio, Carol Masser in the radio booth, and oh, looky here, Tim Stenovic, back from the wild as we welcome our audiences across all of our Bloomberg platforms, including our partnership with YouTube. Tim, you know, your shoes were so hard to fill, they actually had to get somebody all the way from jolly old England to come fly over here and fill in for you.
Had I known we could do this exchange program with Bloomberg bureaus around the world, I mean, I might plan my vacations differently.
Guess what? We actually can't. Didn't we already ask about this?
We did ask. Yeah, it was the first thing I asked when I saw my boss this morning. I said, can we go do Steven's show over in London one morning? Like, maybe for a week? It'd be kind of fun.
He does get up at 2 a.m. in the morning, though. He did remind us about those early morning wake-ups. Interesting week, guys. It feels like we're ending kind of with a little bit of a whimper. Looking at the NASDAQ, went down about 0.4%. But the stocks, Scarlett, those headlines on NVIDIA, some concerns, that's been under pressure all day. But the stocks is down about 1.6% here today.
Yeah, that's definitely the one I'm paying attention to. But, Carol, I can't believe you didn't mention the Golden Dragon Index yet.
It's only been 30 seconds.
Gainers to come.
But you know what's interesting? What's interesting is Bank of America, Hartnett was talking about sort of if you have 10-year Chinese yields stay around 2%, that's really the green light into the unloved stuff, unloved commodities, industrials, metals, materials, and international stocks.
Yeah, absolutely here. A mixed day here on Wall Street, though, as we're going to talk a lot about here on a weekly basis here. We are looking at pretty strong gains across the board. The Dow Jones Industrial Average on the day is going to be higher, up about 130 points or so, roughly about 0.3%. Of course, also posting a third straight week of gains. The S&P 500 up about down about 0.1% on the day. The Nasdaq down about 0.4% here on the day. But the Russell 2000 actually an outperformer here on the day, up about 7/10%. Dow Transports up a similar amount. And we should just reiterate one more time, Carol, across the board, the Dow, the S&P, the Nasdaq indices, and the Russell all posting a third straight week of gains.
Yeah, pretty amazing, right? The strength and momentum that we've been seeing as of late. I'm going to go back to the S&P 500 overall, guys, and most names, or a majority of the names, higher in today's session. 335 gaining ground on this Friday. You've got about 165 losing ground, and then Scarlett, you had 3 unchanged.
Yep, and you look at the IMAP that shows the S&P 500's 11 sectors. It's a real mix there. Tech, obviously, the biggest sector in the index, leading decliner here, losing 1%. You mentioned NVIDIA earlier. That's a big reason why. Materials actually losing about 0.25%, even though they do finish the week as your best performers. For today, energy stocks finishing in the green, up by better than 2%, recouping yesterday's declines. And of course, as oil prices move up now today.
All right, guys, let's get to some of the individual gainers. Number one in the S&P 500, Wynn Resorts, a gain of more than 7%. And in fact, it looks like it is the best performing name in the S&P 500 for the week overall, with about a 22% gain. So we've seen some significant moves in that one. So again, 7% higher. Morgan Stanley raising its rating to overweight, citing a combination of near low valuation and an underappreciated opportunity in the UAE, so United Arab Emirates. They set a price target of $104 a share. The stock closing at $97.62 a share. All right, Rocket Lab. Thank you, Tim, giving me this one. At its highs, up more than 18%, finishing the day at a gain of about 12.5% here. KeyBank Capital Markets analysts raising the target to $11 from $8 a share. The stock closing at just under 10, maintaining its overweight rating. The analyst continues to believe that the company is positioning itself to be an industry leader in both launch services and satellite manufacturing design. Stock is up about 75% here in 2024. We spoke with the CEO and founder, Peter Beck.
They're trying to be a SpaceX competitor.
They are.
Yeah.
Pretty interesting, and you can find that on our podcast feed in case you're interested.
Ooh, nice.
And this, as Scarlett mentioned, the NASDAQ Golden Dragon China
there it
Index. Yay! Up 4% in today's session. And we know, rallying again in today's session, I should say. That index is up, guys, about 24% for the week overall. Chinese equities capping their biggest weekly rally since 2008. The trading in Shanghai, so overwhelming. They had some problems really processing all of those orders. And we know that there's been a massive round of different types of stimulus. The Chinese government really coming out to support the equity markets and real estate and so on and so forth. David Tepper coming out and saying he's buying more of everything related to China after Beijing rolled out those sweeping stimulus measures. That's what you missed this week, China's stimulus.
Well, speaking of Beijing, kind of a good segue to my first decliner, NVIDIA. Shares of NVIDIA falling by about 2.2% today. This after Bloomberg reported that Beijing is stepping up pressures on Chinese companies to buy locally produced AI chips instead of NVIDIA products. It's part of the nation's effort to expand its semiconductor industry and counter those U.S. sanctions. After the Bloomberg News story came out, shares dropped as much as 3.85%, but bounced off those lows to close lower by 2.2%. The move designed to help domestic Chinese AI chip makers gain more market share while preparing local tech companies for any potential additional U.S. restrictions. This is according to people familiar with the matter. And shares of Costco falling today by 1.75%. The company did post higher than expected profit as moderating prices fueled consumer spending. Store traffic also climbed. The company did report a narrow miss on revenue estimates. We did get some interesting commentary from the CFO, who said that as inflation cools, shoppers are purchasing more non-food items. So think home furnishings and tires sold particularly well, he said. Consumer electronics and appliances, he said, were actually getting cheaper. And finally, ADRs of Novo Nordisk here in the United States fell 2.85%. This after JP Morgan analyst Richard Vosser said Novo's third quarter results may show slower than expected sales of their weight loss drug Wegovy. Novo's now trading about 20% below June's record high. It's lost about 1 trillion Danish kroner. That's about $150 billion in market value. We do get the next report from Novo this coming November.
All right, I'm taking a look at the bond market. Before I get there, though, guys, I want to point out SPW, the equal weighted index, closing at a record high. I'm just putting that out there. S&P couldn't make it, closing a little negative. SPW definitely did. That's 20 record highs so far this year. Bond market also seeing a bid. You're seeing yields lower, 2-year yield down by about 6 basis points, the 10-year yield down by about 4. That curve coming in at about 19 basis points. But guys, treasuries are looking at 5 straight months of gains. This will be the longest winning streak since 2010 if we can continue this rally come Monday.
All right, guys. So let's get to some of the interesting stories on our radar. And I feel like we're taking cues.
Were you dancing? Was Romaine dancing?
I was. I didn't realize I was on camera. Penguin dance.
You're always on camera.
Shout out
Romaine.
to Tony Kornheiser.
Yeah. How you dance? Come on, everybody.
Romaine on Friday, everyone.
Love it.
Oh, yeah.
All right. Well, they're not dancing in the Swiss Alps. And I feel like in this New York, I don't mean to be such a bummer, but this New York Climate Week, looking overseas to what they're doing over in Switzerland, the Alps there, Tim, actually, this came up on your radar. They're tweaking the border because of climate change.
Yeah, so climate change is melting the glaciers that have historically marked the frontier between Switzerland and Italy. So the government of Switzerland said in a statement today, significant sections of the border are defined by the watershed or the ridge lines of glaciers, firn or perpetual snow. These formations are changing due to the melting of glaciers. Europe's the fastest warming continent. And there's some serious border-changing implications of this.
Can I tell you, I almost caused an international incident at that border.
You did?
Yeah, we went skiing, and
Love this.
and there's a part where you can ski across the border, but we forgot our passports.
And they checked?
Oh yeah, yeah.
Really?
I mean, yeah. You don't like literally just ski across. I mean, there's a checkpoint.
Really?
Yeah, but it's like a whole thing. Like you go, there's a specific
because it's
slope.
EU versus Switzerland, right?
Yes.
Yeah, that makes sense. Okay, that makes sense.
Eurozone versus Switzerland.
Thank you. Okay. That must have been quite an
Lucky you're
experience.
here, Roman.
I mean, they were nice about it. And
You're always causing
they just shoot us
problems,
back up
aren't
on
you?
the.
They're just like, oh, look at those dumb Americans.
Yeah,
okay,
exactly.
go.
Well,
Goodbye.
speaking of experiences that don't always come out the way you planned, there was something that took place in Detroit called the Bridgerton Ball, which was meant to evoke the hit Netflix show, except it didn't go off at all.
Oh, that looks lit. No,
yeah, I mean, everyone's dressed up in their finest Regency wear. And
like so happy.
I mean, look at that. There's no tables there, and here they are. This is a TikTok
chairs
actually
either.
talking about how it didn't go well.
What is that?
But there was no ball. There was a pole dance.
What? Oh.
There's a pole
Really?
dancer, yeah, instead.
Okay.
Pole dancer's name was Lady Whistledown.
No,
Oh, really?
Really?
No,
Wow.
that's too far.
Okay.
That's actually pretty funny. But just so those of you who haven't seen it, Bridgerton is not about pole dancing.
No.
So thinking
I have not seen the
like,
show.
Yes, essential background information. Thank you, Alex.
Thinking like Elizabethan time. Well, not as.
So this
Elizabethan time,
seems like it has like little undertones of like, Fire Fest, or I don't know if you saw that Willy Wonka thing where it was like literally like, they just like got like a 5-year-old off the street and like put him in an Oompa Loompa costume.
Okay, to be fair, none of these were officially affiliated with Netflix or Bridgerton. It was some like local event company putting on
$150 a ticket though.
Show. Yes.
What?
$150 a ticket.
Wow.
Did you guys,
did they get refunds?
Did you see the one TikTok
No.
quote? Every backdrop looks like it came from Party City.
Probably did.
That hurts. That hurts.
A little
that really
bit
hurts.
of shade. Little bit of shade. All right, guys, that's a wrap. Have a Bridgerton weekend.
Yeah.
If only.
I am
Charlotte
so
was really
with
good,
you.
by the way.
Yeah, Queen Charlotte was great. Super
If
good.
only. I have nothing to say. We'll see you on Monday, everybody.
Romain hasn't watched Bridgerton. He doesn't know.
All right, we're going to continue our coverage here on Bloomberg Television. We're going to get Carol up to speed on Bridgerton. But before that, we are actually going to talk about investor sentiment right now. UBS out with this latest Investor Watch report. We're going to break down how optimistic American investors and businesses owners are about the direction of the economy. Angeline Newman, managing director over there, going to be joining us in just a second. This is The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romain Bostic here on a Friday afternoon. Stocks kind of ending the week on a little bit of a low note, but it was still a pretty phenomenal week worldwide and certainly here in the U.S. as well. 0.1% decline for the S&P today, but a third straight week of gains for all of the major U.S. indices. And a big part of that is what we saw out of China. China's benchmark index, the Shenzhen Shanghai 300, posting its best week since 2008. The MSCI Asia Pacific Index getting in on that action. That gave a lift to EM stocks overall, which had their best week going back to 2020. No coincidence that this all occurred while the dollar continued to see weakness, down for a fifth straight day. In fact, fourth straight week of declines for the Bloomberg Dollar Index, and commodities getting a bit of a bid here on the day as well. That might have also been tied to China, not because of oil, but because of industrial metals.
Absolutely. And let's stick on the China theme here, because when we look at some of the day's biggest movers, I have to start with NVIDIA, finishing the day down 2%, but it was down as much as 3.9%. And this is after Bloomberg learned that Beijing is stepping up pressure on Chinese companies to buy locally produced AI chips instead of NVIDIA's H20 processors, which already a stepped-down version of what it does sell to everyone else because of U.S. sanctions. Now, the goal for China, of course, is to create its own domestic champions, like a company like Huawei. And right now, this is more guidance than outright ban, but certainly it's putting a damper on sentiment towards NVIDIA. Costco's another big mover on the day. Generally not something that we pay a lot of attention to due to quarterly earnings because it does report its monthly sales performance. And so people have a pretty good read into what it says. But we should mention that Costco reported quarterly revenue that missed analyst estimates, even as EPS did top the consensus. Costco finishing down about 1.8% on the day. Now, our top story this hour, we are T-minus 4 days before a dock worker strike that could shut down every major U.S. Eastern and Gulf Coast port. Union members and port operators disagree on a wide range of issues, ranging from pay to the use of automation. And at stake here is the disruption of more than half of all goods shipped in containers to and from the U.S. By one estimate, a week-long strike could cost the U.S. economy up to $7.5 billion.
Yeah, a big story we're watching. T-minus 4 days to that and T-minus 39 days to the U.S. presidential election. Investors and business owners are split on which presidential candidate is best suited to manage the economy. That's according to new data out. UBS's Investor Watch report surveyed 500 business owners and almost 1,000 investors across the U.S., with most investors leaning toward voting for Kamala Harris and most business owners favoring Donald Trump. We're joined right now by Angeline Newman. She's managing director over at UBS Private Wealth Management. Great to have you here, Angeline.
Thank you so much.
Let's start off here with that split between business owners and wealthy investors. Is there a reason why you're seeing a sort of a split in how they're viewing things?
The business owners tend to have their ear to the ground a little bit more. They've got more concerns over taxes, inflation, a potential recession. They're really concerned about the economy because they know everything going on in their businesses. We also feel like, general investors might lean towards Harris because they like her social policies, they like her health care, they like her green energy, her renewables. The business owners are more looking at Trump's tax plan and his immigration, as well as perhaps reduced constriction on some of the laws in order to make some more deals go through, and even, international trading with other countries.
We talk a lot about the economy and the potential effect of the election on the economy. How are those folks feeling about the economy now?
So good.
Oh, really?
So good.
Yeah.
It's interesting because 4 years ago we did the same survey, and the business owners were 4 years ago, 35% of them were very optimistic. This time it's 45%. The business owners are even more optimistic, believe it or not. I don't know why, but I think we're coming out of this really kind of terrible time that we all went through in 21 and 22, and now we've had this bull market behind us. We know rates are going down. There's lots of reasons to believe that the markets are going to be strong, and hopefully that's good news for the economy.
So it's really interesting that there's such a clear split, but at the same time, the margins are pretty small as well. So
yes.
It just highlights the division out there.
Yeah, they're so close. Again, Romaine said it in the opening. The investors are more leaning towards Harris. The business owners are more leaning towards Trump. One thing that they both say, though, it's interesting, is that they really want to make some changes to their portfolios before the election. And that was overwhelming. It was 77 in one group and 82% in another. Wow. Actually want to pivot sectors depending on how they're leaning. They really want more financial advisor advice, especially the business owners. We take the business owners through planning, growing a business, selling a business, and everything in between. So they're really looking for more advice and more just foresight into what's going on in the economy.
So your portfolio manager, do you see them doing that right now? Do you see them making those changes, or is this something they're talking about wanting to do?
We are. So there are certain sectors, again, if you are leaning towards Harris, you're more likely to lean into the healthcare sectors and, again, the renewables. If you're leaning towards Trump, you're looking at energy, defense, industrials, maybe some financial services. We are always proponents of highly diversified portfolios, including diversifying among sectors. What we really like right now is tech. We like tech. We think AI has so much opportunity. We think that will be the driver of equity returns over the next couple of years. One of our other preferred sectors is actually utilities. We need the utilities in order to fuel the AI craze. So whether it's the data centers or anything else, utilities are having a moment right now, and I think it's going to last. I really do.
Despite who gets elected in November?
Despite who gets elected in November. They were pretty evenly matched on the utilities in terms of how people perceived who would be stronger.
So when you talk about utilities like that, are they really a defensive sector anymore then, or are they kind of an adjunct to growth?
That's a really good question, because they used to be looked at as like your grandmother's stocks, right?
Exactly.
That paid nice dividends and didn't have a whole lot of growth potential. But the world is changing. Again, if you look at some of them, even in the really recent past, you've seen a lot of growth potential.
I am curious, and maybe you can't answer this question, but when we talk about who benefits from this energy build out that seems to be in service of this AI and data center revolution, you had that interesting deal that Microsoft made to kind of restart that reactor at 3 Mile Island. And I wonder if we start to see more sort of private industry deals like this, meaning the ones that don't go directly through the utilities themselves, but rather you get the tech companies themselves basically just say, we're going to ensure that we have enough power, so we're just going to go out there and do it themselves. Is that an investable opportunity, or is that just something so esoteric that you can't really do it?
It's possible, and it also could have a lot to do with who gets elected.
Yeah.
Because as I said before, Trump is sort of less restrictive. He's a little bit more venture-oriented, and, whereas VP Harris is not as much. Again, they both have their qualities that people are really leaning on, that are good qualities, and it's really going to be a close race. My favorite part of the whole survey was that everybody, whether it was investors or business owners, said they want a financial plan. They think a financial plan will help them weather the uncertainty going forward. And that was music to my ears, because that's how we roll. That's what we do.
But what kind of financial plan can withstand something that we don't know is going to happen? I mean, there's so much uncertainty. Anything could happen. There are different variations of what might result in I was going to say November, but let's face it, in January at this point.
Well, that's why we actually can run a couple of different scenarios. We call them what-if scenarios. And, we look at this Monte Carlo analysis, which is an economic term, and we run 1,000 different trials depending on how the markets can go. And we show the clients, the high end of what's likely to happen and the lower end, and we sort of draw a line in the middle. We also have to check in regularly because it's obviously not cast in stone. It's something that we need to tweak and check in with on a regular basis.
All right, good stuff. Angeline Newman, really appreciate your joining us today. Angeline Newman is Managing Director at UBS Private Wealth Management. I love that idea about how, there's this big gap between what investors see and what business owners see. It's almost like the question about the economy is so broad, they can kind of define it however they want.
Yeah, but and you probably even go further down. If you go to their average consumer, you're meaning the non-business owner, just the average Joe in the street, you're probably going to find some of the similar disparities. And it gets to that whole idea that we focus so much on the data on this program for good reason. We are data dependent, as we like to say. But we also know that that data doesn't always tell the full truth, right? That the way people interpret that data and view it can be very disparate.
And it doesn't reflect a lot of people's lives either.
Yeah.
That's the other thing, right? I mean, the data's out there and you're like, yeah, but that's the average of everything that takes place in this country. In my world, this is what's happening.
Absolutely.
All right, coming up, it's Factor Friday. We've got Cain of Bloomberg Intelligence joining us next to talk about the factors to watch for this week and for next week. This is The Close on Bloomberg.
October 1st, with the election weeks away, the VP candidates are set to face off.
When we fight, you guys are going to get me all fired up again.
Trust Bloomberg for news and analysis.
So is it style or substance or maybe both? We'll be hearing from Tim Walz and J.D. Vance in prime time.
Yeah, and the question is whether the vice presidential nominees are actually able to move the needle.
Tune in for the CBS News Vice Presidential Debate simulcast with special coverage starting at 8 p.m. Eastern. Context changes everything.
It's time now for Factor Friday. We saw U.S. stocks close the week on a down note, even as they wrapped up 3 straight weeks of gains. Joining us now for more on what he's watching is Cain of Bloomberg Intelligence. And Chris, you do this every week, but you recently updated your Factor scorecard. Tell us what you found.
Yeah, so our factor scorecard is something that we update every quarter, and the aim of this is to aid tactical factor decisions for portfolio managers. So like which factors should they emphasize? We really use the trends of the long short factors and the historical valuations between the long and short legs to kind of guide our scorecard. So low volatility is number one. It's been the strongest performing factor in the U.S. this year. It's really taken off over the last three months, as we spoke about. We are at all-time highs, but there is a bit of a defensive nature to the market in some ways. So it's really helped low volatility. It's not very expensive. Quality is number two. Again, something that's worked very well. Worked very well over the last 3 months. There is some red flags, though, with quality as far as valuations. Like the high-quality companies are very expensive. Momentum has kind of been knocked down a peg to the middle of the pack. Momentum started really strong, has kind of pulled back, but has a lot of fundamental backing. And then value and small size kind of round out the scorecard.
Is this normal at this stage? Low volatility, quality, leading the charge when we're at record highs, Chris, and we talk about this idea of that defensive long-short factor, low-vol factor. Why would that do better in an environment where we're already at record highs? Wouldn't that sort of come later or no?
I totally hear you, Romaine. Yeah. I had the same thought. I had like some cognitive dissonance, when I was doing this scorecard. Like, how are we at all-time highs and I'm telling people to buy low vol stocks? Does that make any sense? So I actually looked at this. So over the last 20 years, since 2004, I took the 10 best S&P 500 years and looked at what long, short, low vol did. It was actually up in 7 of the 10 times. So it doesn't mean that just because the market is going up that low vol stocks trail high vol stocks. They actually tend to beat high vol stocks. It's a little counterintuitive because you would think with a bull market, there's a lot of risk taking. Maybe people reach for those high vol stocks and bid them up. But historically, it's been the opposite. The actually median return for a long, short, low volatility factor in those 10 best years was 9%. So again, low vol stocks beating high vol stocks by 9%. So that was pretty interesting, and was helpful to me in the sense of being positive on the low vol factor as we go to all-time highs.
So can you give us some more context there, where you showed us examples of years where the overall market did okay, but the long-short low-vol factor didn't do as well. What was going on during those times that might explain what happened?
There's exceptions to everything, Scarlett. So there's a couple years where the relationship that you would just kind of intuitively think would be true was true, where the market generally did very well and long, short, low vol went down, meaning high vol stocks beat low vol stocks. So the three big years where this happened was 2009, 2020, and 2023. And the kind of string that they all have in common is those are years of recoveries, right? Either after bear markets like in 2022 or after outright crashes like in the global financial crisis, obviously the COVID crash in 2020. Mm-hmm. So it's those recovery years that really hurt low vol. If it's just a continuation of an uptrend, which if we go up next year, that's what it would be.
Yeah.
That hasn't really harmed low vol as much.
Got it. Thank you so much, Chris Cain. Chris Cain of Bloomberg Intelligence with the new Factor Scorecard. Coming up, we've got the top three movers and shakers at the center of the day's big stories. This is The Close on Bloomberg. Time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Aaron Judge. All rise, everyone. The Yankee slugger leading New York to the American League East title while also making team history. He recorded multiple home run streaks of at least 5 games in his career. He's kind of the presumptive AL MVP at this point with a .325 average and 144 RBIs.
Yeah, it'd be great to see as they make that run towards the World Series, right?
Yes, of course.
No, they're not going anywhere. But no, good for him. No.
Wait, how are your White Sox doing?
They did not do too well this year, but hopefully they'll avoid history of a dubious kind for that matter. We can talk about that a little bit later.
Yeah.
It kind of hurts
I know.
Scarlett.
That's why I had to say it.
Thank you. I'm keeping an eye on the CEO of WW, the company formerly known as Weight Watchers, and we should call her, well, the former CEO. Yeah. Seema Sistani has been ousted from her role as CEO. And of course, I don't know, this was kind of one of those jobs where, I don't know, she was almost doomed to fail, right? I mean, this was a company that really just skyrocketed. It was kind of left for dead. Then, I don't know, a few years ago, Oprah joined the board. It skyrocketed. Then that kind of fell by the wayside. It tried to find its footing. And now it kind of got caught up in the whole Ozempic, Wegovy craze. And nobody really knows what the purpose of WW
It's in an existential crisis, absolutely.
And it just needs to figure it out.
Yeah, I mean, people, it says that it offers a community, but do people really want a community, or they just want to lose weight by taking a pill or getting an injection shot, right? So that's kind of what it comes down to.
Yeah, well, they didn't. I thought they were going to do that, right? Weren't they going to offer that or something? And then you have the community of, I don't know, what do you give each other shots?
Yeah, you could do that on social media too. By the way, she leaves the company with a valuable perk up to $37,500 of executive coaching through year end and $50,000 of her legal fees and a month's pay at her current salary.
Okay. So, all right. That's not bad.
Yeah.
All right.
Nice parting gift. All right. And third on our list is Maggie Smith, the British actress best known for her roles in Downton Abbey and the Harry Potter series, has died at 89 years old. We're talking about 6 decades in showbiz, on stage, on movie sets, and in TV shows.
Yeah. I mean, obviously, a lot of people, at least the newer generation, knows her from Harry Potter, but Maggie Smith has been in everything.
Yes.
I mean, obviously one of the great character actors of multiple generations, really. I mean, you go back to the 60s and 70s, and honestly, you think of a major movie, there's probably her face somewhere in that somewhere, whether it's a big role or a small role. A lot of people today really mourning that, whether you're a Harry Potter fan, whether you're a Sister Act fan, as one of our producers is.
Or a Downton Abbey fan.
Or Downton Abbey, which I used to always call Downtown Abbey. But anyway, obviously just a giant of stage and screen.
What was your favorite Maggie Smith role?
I don't know. I mean, I was going on the fence about this, and then I was thinking, most of the roles that I remember her best in were those really small roles where she just appears for 10 minutes and just blows everybody else out the water, and then you never see her
and
again
that's talent,
in the rest
right?
of the movie. Yeah,
to be able to make an impression like that.
Yes,
yeah,
it's just. I mean, obviously her bigger roles in Harry Potter. Obviously, most people have gravitated to that. That was a little past my time for movie viewing, but certainly some of the older stuff.
I totally agree. And by the way, she was named a Dame in 1990, so we should call her Dame
Maggie Smith. Absolutely.
Rest in peace.
We have to be very clear that strike doesn't happen that often in the U.S. market. And so for the workers to get to the point of threatening to walk out on October 1st, it tells you a little bit kind of the fed up situation in which workers could be.
That was Gilbert Humbo, the Director General of the International Labor Organization, a UN agency, as East and Gulf Coast ports brace for potential strikes starting on Tuesday. Now, the world's top container carrier is urging customers to move U.S. cargo before then. Let's bring in now Lee Klaskow of Bloomberg Intelligence. He covers transportation, logistics, and shipping. And Lee, this feels like this strike is a long time coming in that they had been talking and trying to resolve things since the summer, and it had gotten nowhere.
Yeah, the two parties appear very far apart on a lot of issues, pay and work rules. It seems pretty evident that there probably will be a strike on October 1st for the workers up and down the eastern seaboard and the Gulf Coast ports. It's about 25,000 individual jobs and about 45,000 people that this contract includes. The union is apparently looking for a pretty large rate increase. Over the 6 years, they're looking for a 77% increase in their pay. They're trying to really get to parity to kind of how the West Coast is being paid, because the West Coast workers on average make more an hour than their East Coast counterparts. So they're looking for higher pay, and obviously they're doing everything they can to limit the amount of automation that hits the ports. Again, on the East Coast and Gulf Coast ports.
Yeah, I am curious about the reverberations from this. We should also point out we're also getting reports of certain ports in Canada, at least on the Montreal side, also potentially shutting down as a result of this. Has there been any discussion about intervention by the government in this process?
Well, the Biden administration said they're not going to enact the Taft-Hadley Act, which would force the two parties into an 80-day cooling period where they would bring them back to negotiation. So it would kind of delay any sort of strike. I assume, and my guess is that if this goes to a strike and the strike lasts more than a week, the Biden administration might have to change its tune. There's estimates that this could cost the economy about $6 billion a week for every week that a strike happens. And obviously, our listeners know and viewers know that the U.S. economy is pretty fragile right now. We're having growth, but tepid growth at that.
Yeah, and of course, this comes also before the holiday shopping season at the end of the year as well. We mentioned how the world's top container carrier is urging customers to move U.S. cargo before then. Given that this has been something that kind of was hanging over us for so long, what do we know about workarounds that manufacturers and retailers have already embarked upon?
Yeah, so our channel checks indicates really sophisticated shippers have been diverting freight away from the East Coast and Gulf Coast ports for quite some time because they knew this day was upon us and they just needed to hedge their bets, if you will, or they were pulling forward freight. So if they're maybe originally thinking, oh, we need this stuff by October, maybe they'll bring it in August or September to make sure they have the goods that they need at their shelves. So what you're going to see is the West Coast ports continue to win share. Their recent monthly data numbers were extremely high. You've also seen Union Pacific, which is a major Western railroad, show really great intermodal growth in the third quarter. Especially the last couple of weeks, and that's really been driven by more and more freight being diverted to the West Coast. And then shippers will have to take that freight and move it inland, so that could benefit companies like J.B. Hunt and Schneider, which are two large intermodal marketing companies, also Hub Group. So it's really could be the shock that provides the freight markets with higher rates, because the freight markets in North America we've been in a freight recession for about 2 years. And so this could be the shock that could really help the truckload carriers, the LTL carriers, and the railroads.
All right, Lee, going to have to leave it there. Lee Klaskow over at Bloomberg Intelligence. So keeping an eye on the labor negotiations or lack thereof regarding those East Coast ports, a strike that could start as soon as Monday night. All right, we do want to turn our attention to politics, particularly local politics here in New York City. The mayor of this city, Eric Adams, earlier today was in a New York courtroom. "I am not guilty, Your Honor." Those were his words, facing arraignment for corruption charges. We're joined right now by Michael S. Weinstein. He's the chair of white-collar criminal and government investigations practice at Cole Schultz. Michael was also a federal prosecutor with the U.S. Department of Justice in Washington, D.C. All right, we did hear from the mayor earlier today, Michael. Obviously, a very brief statement, as you would expect, given the circumstances, a plea of not guilty. Walk us through the process right now of what prosecutors are going to have to do to try to make this case.
We're going to have to collect, obviously, the evidence and ultimately disclose it to the defendant and his very able counsel, Alex Spiro. And in doing so, they're going to look at emails, they're going to look at text messages, they're going to look at communications between Mayor Adams and or his surrogates and various Turkish officials, both here in the United States and abroad. And by doing that, along with witnesses, their case is going to be based upon that those actions were improper and illegal on their face, and they violated various federal statutes, and that's why he's charged with bribery and conspiracy and fraud and things along those lines.
A lot of us really sat down yesterday and spent a couple hours really reading through the actual indictment when it was unsealed, and some of the details were known, or at least the contours were known prior to this because of media reports. But I think it was still staggering to see it all laid out here. And I do wonder, is this going to be a case that is about physical evidence, meaning physical evidence of impropriety, or is this going to be more about getting witnesses to point the finger at Eric Adams and he said he did this?
It's going to be a combination of both. Look, anytime you see a corruption allegation, whether it's Senator Menendez from last year or the year before, or the former lieutenant governor from New York who was charged with bribery, it's always ugly. You have a higher expectation for politicians and for public officials to carry themselves in a certain way. So Mayor Adams and the allegations against him really hurts. And when you see the facts laid out as bare and as graphic as they have been by the Southern District of New York office of the federal prosecutors there, it's ugly. And but I think you're right. It's going to be both physical evidence, checks and financial transactions and election type fundraising, as well as witnesses who testify as to what the intent was of the mayor and his surrogates in trying to collect and do things on behalf of the Turkish government or Turkish representatives.
So Alex Spiro, who of course is Eric Adams' attorney, has reportedly said that he wants an expedited trial. What does that mean in practice? Is that good for Eric Adams or bad for Eric Adams? And is that good for the government or bad for the government?
It may give, from a political standpoint, and I'm not a political reporter, but I think I can suspect that the quicker that his counsel asks for a trial, the more that Mayor Adams can say, give me a chance to make my arguments. Our trial is scheduled 6 months, 8 months from now. So, Mr. and Mrs. John Q. Public, bear with me while I fight these charges. But if the case goes on for a year, 18 months, I think that's harder for him to argue, and he loses some of that political capital. But a defense lawyer, in wanting the case to go more quickly, he's trying to force the government's hand and produce the documents and produce the evidence that's necessary that they would then review and challenge it and things like that. So even though he may say, I want it to go quickly, I suspect he's going to file a motion to dismiss the charges. He's going to challenge some of the evidentiary issues at hand, and that may slow it up inherently. And so the case may not happen so quickly, even though he says he wants it to happen quickly.
Okay, got it. Understood. So aside from his lawyers seeking dismissal of the charges next week, what will you be watching for, Michael?
I think they're going to have, obviously, a media component of this, is whether or not they're going to have, somewhat of a Trump-like media campaign along with the defense that they put forth. I think the one thing to look out for here is the quid pro quo. So the defense lawyers in the case here, because of recent U.S. Supreme Court cases on public corruption matters, the U.S. Supreme Court has said there's got to be a direct link between the giving of something to a politician and what that politician then does. And if there's not a direct link between those two actions, the courts and the Supreme Court have really said public corruption cases like that and charges such as this, fraud charges and bribery charges, can't be brought. So what I would look for is the defense lawyers in this case to be challenging the corruption cases and the bribery case here under the theory that there was no true quid pro quo and the evidence doesn't support it.
Understood. Thank you so much, Michael. Michael Weinstein is chair of White Collar Criminal and Government Investigations Practice at Cole Schutz. Now we want to continue on this subject because these charges have huge historical significance, not just for the city of New York, but also the state of New York. And I want to bring in Terry Golway. He is professor of New York City history at the College of Staten Island. Professor, just give us some context here in terms of this indictment and the arraignment of Mayor Eric Adams. How common is this for a sitting mayor to be indicted?
Well, that's a very good question, because it's been reported all over that Mayor Adams is the first sitting mayor of New York to be indicted. That's actually not true. There was a mayor back in 1870 during the reign of Boss Tweed named A. Oakey Hall, and he was not unlike Mayor Adams in the sense that he was a sharp dresser. He was known as Elegant Oakey. Well, he was also known as Indicted Oakey. He was indicted for many of the sort of similar charges on fraud and bribery, and he was brought into a courtroom twice. First time a mistrial, second time a hung jury. And so there is a precedent for what is happening with Mayor Adams.
Yeah, but having that precedent be during the Boss Tweed era is never a good thing in terms of just, being a headline. So if there was a precedent in terms of a mayor being indicted, are there other mayors who were in similar trouble who stepped down before it got to that point?
Yes, as a matter of fact, twice in the 20th century, two mayors who were on the verge of indictment. One was Jimmy Walker, who also is sort of similar in style with Mayor Adams. People have pointed that out almost from day one, that Jimmy Walker and Eric Adams had a lot in common in terms of their style, in terms of their embrace of the nightlife. Again, maybe not a sentence you want your name to be in, because Jimmy Walker resigned on September 1st of 1932 after undergoing an investigation by the then governor Franklin Roosevelt, who brought Walker up and for 2 weeks questioned him about his corruption. And many people thought that Roosevelt was on the verge of removing Walker, as a governor can do, and then Walker sort of did the right thing by resigning. Then there was another mayor called William O'Dwyer. He was mayor after Fiorello LaGuardia, was a hero cop, if that sounds familiar. Mayor Adams was a police officer as well. And he too resigned in the face of charges, or at least in the face of an investigation, and later became ambassador to Mexico.
Oh, wonderful. Terry, I am curious here. Look, let's just set aside whatever is going on with Adams here. I mean, there's a long line of corruption in this city, whether proven or alleged. When we talk about Eric Adams, his persona, and what we know about him publicly, do you think there's any possibility that he would resign prior to actually any sort of conviction?
I do think so. Precedent suggests that so much political pressure will be put on Adams that he will have no choice. And those of us who've been covering New York politics for a long time, and I was a journalist as well as being a professor, we've heard it all before. We've heard any number of political figures say, I'm not going to resign. George Santos said he wasn't going to resign.
Yeah, well, George Santos was a nut job. But Adams is a little bit more savvy, or at least he sort of portrays himself as being savvy. I know he still has a lot of political support, and he certainly has voter support as well. Would that be enough to protect him?
Well, does he? I'm not so sure that he has that voter support. He didn't have it wasn't exactly an overwhelming victory in the Democratic primary, back when he ran. But yes, if you have public support, that's helpful. Jimmy Walker was very popular.
Yeah.
To the day he resigned.
Any chance Kathy Hochul, the governor, will actually move to remove him?
She is going to be under tremendous pressure, as Franklin Roosevelt was in the case of Jimmy Walker. Mm-hmm. But the important thing is, though, that Walker was never indicted, and yet he resigned.
Oh, okay.
As you know, Eric Adams has been indicted. So arguably, there's a stronger case for removal. But then again, you're innocent until proven guilty.
All right, Terry. Well, absolutely, and we should point that out. Of course, the mayor has pled not guilty to those charges. Of course, we did, as always, have been reaching out to comment from him every day. Of course, he is not talking to the media. This will play out in the courtroom. Terry Golway is a professor of NYC history over at the College of Staten Island.
And of course, there's a lot of speculation, Romaine, before we get to the markets, that one former New York governor might kind of step in and offer himself up as a savior here. Andrew Cuomo.
Oh.
There's a lot of discussion on that.
Okay.
Doesn't sound like you have much to say on that.
Is he here? Okay, because I have some questions for him too.
All right. Let's go back to the markets for a moment here. And because even though we did close down.
Didn't he write a book or something?
Did he write a book?
Yeah, he did.
What's it called?
I don't know. I felt like there were some issues with that book, though.
He wrote a book?
Yeah.
How many people read it?
Not me.
All right. Let's take a look at the S&P 500. Down slightly, but up for the week, and up for 3 weeks, in fact. And the S&P equal-weighted index finished with a record high. And one big reason why there's such a tailwind for equities and for risk this week was because of all the stimulus measures announced by China, whether it's on fiscal stimulus or monetary stimulus.
Yeah, absolutely. And of course, that did change sentiment, certainly overseas and certainly back here in the U.S. It'll be interesting to see if that carries over into next week. Of course, next week could be a big week with some key data coming down the pike. We're going to set you up for what investors will be keeping their eye on over the next few days. This is Bloomberg. All right. It's been a wild week, and maybe next week could be even wilder. Here's what the markets are going to have their eyes on over the next few days. And we start off on Monday. Earnings, Scarlett, they're still going on for some reason.
They're still going on. Carnival will be releasing results. And of course, we know that there's been a lot of demand for those cruise ships and everything. But it'll be really interesting. Of course, another read on the consumer here. Also closing arguments for the Tapestry Capri situation that the FTC is trying to block.
Yeah, that'll be interesting to see how that all shakes out as well. Jay Powell also scheduled to speak at the NABE conference, which kicks off on Monday. And that brings us to Tuesday here, where we do get some interesting economic data that could, I don't know, maybe move the needle, including that JOLTS data that we used to pay very close attention to.
Yeah, we are now increasingly because these are high-frequency data points, and it's all about the labor market and whether it's going to hold up here or whether it needs some more support from the Federal Reserve. Nike reports earnings, which will be really interesting because they have a new leadership in place, right?
Yeah, I'm going to be curious about that to see what they have to say here. Of course, after John Donahoe being moved out and the new CEO, I guess he won't technically be on the job yet, but interesting to see what he has. We also get a vice presidential debate, too. We're going to finally hear from J.D. Vance and Tim Walz talking head-to-head with each other.
Well, are they going to talk or are they going to yell? It's not clear.
I don't know. I mean, are they going to be able to mute their mics or something like they tried to do with the last one? I don't know. Anyway, I'll catch it all on social media at the next day here. We get some earnings out of ConAgra. OpenAI also having a developer day on Tuesday, and then on Wednesday, we get the ADP employment data, that drumbeat to the Friday job.
Right, and ADP employment will be followed by jobless claims on Thursday as well. And all of that is kind of in service to the eventual big data point, which is on Friday. But before we get to that, we also have ISM services, and there's also an employment component within that report that investors are really going to scrutinize.
Yeah, and we should point out, of course, that jobs report on Friday. I do want to go back real quickly, that OpenAI investor day earlier in the week, a headline now crossing the wire from the New York Times, saying that OpenAI expects $3.7 billion in annual sales this year alone. That's a New York Times story. We'll try to get you some more details on that. Scarlett and I will be back next week on The Close. Balance of Power is coming up next today, right here on Bloomberg